So hi and welcome, a warm welcome to Data Explorers Market Update. I'm Will Duff Gordon. And just recently we have completed the partnership with CapIQ, the division of Standard & Poor's, where our data is available, which is very exciting for us and for our client base. And to sort of mark that occasion, we've harnessed less than 1% of the power of that channel in order to look at a really interesting question of the day. With so many sort of black swan and unusual events in financial markets taking place so frequently, the key thing is to look at investor sentiment and try and say, okay, when the next storm comes along or the next major market dislocation, where is a good place to hide based upon what happened last time? And so what we've done is we've looked at the CapIQ data alongside our securities lending and borrowing flow data to look at the 20 companies that fell the most in price since the 1st of August and the 20 companies that increased the most in price since the 20th of August, and basically said, who kind of predicted this? Was it the institutional owners through our kind of the proxy we have for that through the data and lending programs, or was it the amount being borrowed, the short selling data? And most of the story here is in the table that goes within this piece. But if you'd like me to summarize, it goes as follows. Short sellers were kind of pretty good at anticipating which stocks were going to fall the most. So as you would expect, where they are prepared to pay borrowing fees and short sell shares and take risk, they are getting that right. So the 20 stocks that fell the most, in aggregate, the short interest was 4.3% in those 20 stocks against an index average of 2.4%, so a little under, sort of double the index average. Now, how did the institutional owners fare in those stocks? Well, they were pretty equal weight. A typical S&P 500 stock has 25% of its shares in lending programs, and the institutional investors had 24 point something in those stocks that fell the most. So they did not, particularly the US mutual fund community typically, did not avoid owning those stocks that fell the most. So if we then go and look at the positive side, the stocks that rose the most, short sellers was particularly low in this sector. So again, they were not shorting the utilities, the kinds of firms that performed the best over this tumultuous period. Also, the institutional investors were not overweight. They were not buying. They did not predict that these stocks were going to do well. They only owned 21%. So they were typically owning 25% of any given stock. On average, they owned 21% of those stocks that performed the best, which is slightly depressing if your assets were being managed by a typical mutual fund. And this actually is not a flash in the pan result. It ties in with some research we did after that sort of big price fall in the first week of August that showed exactly the same thing. Stocks with low institutional ownership seem to outperform those with high institutional ownership. And we're going to do more of that on and research, and a special piece of research later this week to see if it could be a particular quant signal. So where are we now? Well, the short sellers have sort of like a doubling there, well, not doubling, but doubling down there, kind of shorting more of those stocks that have already fallen. So they're not anticipating things like Netflix, United States Steel, AK Steel, and others are going to suddenly turn around. So there's more short, so it's about 5.1% is the short interest in the stocks that have fallen the most. While the institutional investors, they take the other side of the coin. They basically have bought more shares in those stocks that have fallen, expecting a price rebound. And every politician in the world will be hoping that they are right and that we have a bit of a rally and a recovery and the short sellers are wrong. You probably regret listening to this video because the table may be easier. If you'd like to read the report and see the table, it is at dataexplorers.com/news.